So the stock market will crash. It's happened time and time again. This is the scary truth. However, it doesn't have to be a bad thing. As long as you are properly prepared, you can benefit from the chaos. There's an old Wall Street story about a billionaire who once said, "The next crash, I don't fear it. I prepare for it. Crashes build more wealth than booms ever will." Most people laughed at him, until the day the markets collapsed, and while everyone else panicked, he quietly bought an entire shopping mall. Cash, upfront, during a recession. And that's the thing nobody tells you. Crashes don't just destroy wealth, they transfer it. So today I want to share the knowledge that has helped billionaires make millions through multiple market crashes. We're breaking down exactly how to be on the right side of that transfer. Most people lose money in a recession, but a small group of people, less than 5%, make life-changing wealth during the exact same crisis. You'll learn how to become one of the 5%, how you can spot the warning signs of a crash and use them to your advantage. But first, the quick warm-up question. What's one thing you wish you invested in sooner? Drop it in the comments. I'm sure someone has done the same, or actually invested. Let's find out. So first of all, what does a recession feel like? Let me tell you a story. Once upon a time, in a peaceful forest, there lived a squirrel named Bob. Bob was confident. Bob was chill. Bob was stacking nuts like ETFs on autopilot. Until one cold October day, the markets, winter, hit earlier than expected. Suddenly, every animal panicked. The rabbits were selling nuts for half price. The owls claimed they knew this would happen. And Bob turned into a full-blown motivational speaker on the tree stump. This is basically what humans do during recessions. People panic sell. Social media becomes a wasteland of fear. And everyone suddenly thinks the world is ending. If you've lived through 2008, 2020, or 2022, you know exactly how that feels. Comment, "I remember 2008/2020, if you lived through one of them." But here's the twist. These emotions are predictable. They happen every single crash. And knowing how people react tells you exactly what opportunities are coming. Now let's dive a bit deeper into the market crash history. How common is a market crash? Well, there are 3 different types of market decline. First is the most common type of decline, a market correction. This is defined as at least a 10% drop from a recent high. These can be caused by various factors, but think of it as the stock market realizing it's getting a bit expensive and cutting back prices. On average, these have happened around every 1.5 years since 1980. The second most common type of decline is a bear market. You know when you're in a bear market when prices have dropped more than 20%. Since 1932, these bear markets have popped up on average every 4 years and 8 months. They tend to keep dragging the market down for about 289 days, or roughly 9.6 months. Sure, that sounds like a long time, but keep in mind that bull markets, which is when the market is going up, usually last around 965 days, or 2.5 years. The third type is a stock market collapse, which I class as an over 30% drop in the stock market, normally within a very short amount of time. Although these are very uncommon, still they can happen. To summarize all these, just note that a crash happens roughly every 7 to 10 years, a recession every 5 to 6 years, minor corrections every year. In other words, if you're 30 now, you'll experience another 5 to 7 major crashes in your lifetime. So instead of fearing them, you might as well prepare to profit from them. Food for thought. If you aren't ready for the stock market to go down sometimes, then you shouldn't be investing in stocks. Now that we understand the dynamics of how a crash occurs, how do we predict what's coming? These are actual warning signs seen before every major crash. People bragging about unrealistic profits. Stocks rising even when companies report terrible earnings. Tech companies firing workers even as their stock prices rise. Government debt skyrocketing. Interest rates rising quickly. And everyone around you saying, "Buy anything, it always goes up." Whenever the world feels too confident, the market quietly sharpens a knife. Let me know in the comments, which red flag do you see happening right now? As we all know, circumstances and outcomes vary depending on how individuals handle their situations. 5 people might experience exactly the same thing, and we can still have 5 different possible outcomes. Which brings us to the big question. What are the biggest mistakes people make during crashes? Let's talk about how not to be Bob the squirrel. 1. Panic selling at the bottom. People lock in losses, then regret for years. They panic, sell, regret, cry, repeat. 2. Stopping investments completely. Millionaires are made during recessions, not after. 3. Buying random cheap stocks. Always remember, cheap is not the same as valuable. 4. Not having cash ready. Opportunity love cash. You want opportunities? Get liquid. 5. Trying to time the exact bottom. The truth is, no one knows. Even billionaires can't do that. Next, how do you predict a crash? Well, let's discuss this as if it's a bad breakup, so you'll know what to look out for. I'll also share the strategies you should use at each stage, backed by real-life examples. This way, you'll be better prepared to see the stuff smart investors look out for. Number 1, the honeymoon. This is a stage where the market is at its peak and irrational excitement drives prices to unsustainable levels. Everyone's rich, everyone's investing. Your dog starts a crypto account. During this stage, everyone is happy and flying high. When you start seeing this blind happiness, you should prepare your investments for when everything comes crashing back to reality. Before the 2008 financial crisis, there were a couple of things I will draw your attention to, so you'd be cautious about investing. First was the boom in consumer spending. Everyone had money. They were spending thousands and the economy was thriving. A more recent example of this is the NFT craze a couple of years ago. Never in a million years would I have thought that people would buy JPEG image files or a tweet for millions of dollars. Things like this are a clear sign of too much money in circulation. The second thing to be noticed in 2008 was the increase in the number of people buying houses or refinancing. This is because it was easier than ever to get credit as the housing market was booming, which meant if people were unable to pay their mortgages, then the banks could take back the properties without losing any money. Now, it's one thing noticing these little clues, but it's another thing actually taking action and preparing yourself. Between 2007 to 8, smart investors didn't go along with the crowd, as the general herd mentality was that everything was great and nothing would ever go wrong. But instead, they start to prepare their investments for the worst. So if your spidey senses start tinkling, these are some of the things you can do to prepare yourself for the worst. First, you should evaluate and minimize your risk level wherever possible. Realistically, you should not be focused on chasing crazy high returns, as that's unsustainable for the long term. You should be more focused on making reasonable gains consistently so your money compounds. Always think about the story of the tortoise and the hare. I know it might sound boring, but slow and steady does win the race. If you're new to investing, there's a high chance you haven't experienced a real market crash. It can be horrifying to see your portfolio completely halving in value and sitting deep in the red for a brief period of time. So you have to ask yourself if you could mentally handle this kind of drop without selling your investment. Secondly, you should start to reduce your leverage. Now, on one hand, leverage is a great way to accelerate wealth, but it can also be very dangerous. The thing is, if a stock crashed too far, then your investing platform may issue a margin call, which means you have a limited amount of time to pay off your debts, and if you don't, your brokerage may sell your stocks at the bottom of the market to recover the money you borrowed. If this is something you're considering or even doing, then if I were you, I would be paying some of this debt off. Thirdly, you should start saving some extra cash in a high-interest savings account. Have an emergency fund of 3 to 9 months of your living expenses. Look at it this way, it's 2022, COVID-19 recession. Everywhere shut down, everyone sit home. Now imagine you've been smart enough to save up to 5, 9, let's say 15 months of your living expenses. Who'd put COVID in a shutdown? Think about it. Finally, in this stage, you should make sure your investments are properly spread out. This is called diversification, and it's one of the best ways to help withstand a market crash is quite simply you haven't got all your eggs in one basket. This is all because you never know what sector is going to be hit the hardest. During the good times, it can be very common for people to do very well with 1 or 2 stocks and end up with most of their money focused in only a couple of different companies. Even if they start out with lots of different stocks, it can almost seem silly to put your money into other things when one stock outperforms all your others. Let's use some of these popular stocks as an example. Say you have $1,000 to invest. Now, you could put all of that into Tesla with the hopes of it going to the moon, but if Tesla gets hit the hardest in a market crash, it won't be great news for your money. Whereas investing into a total US stock market fund would spread your money across multiple different industries. Look, nobody can predict if the stock market's going to go up or continue downwards. However, diversifying goes some way to reducing your risk. Yes, you can't guarantee returns, but at least you're investing in a broad range of sectors. Another great way to diversify while guaranteeing a return on investment is through something called a high-yield cash account. Take a look at this, for example. Let's say you have $5,000 to put by with an additional $250 being saved monthly. Within 5 years, you'd have earned $3,493 without making a risky investment because the account pays you 5.1% interest that compounds daily. Smart, right? Number 2, the red flags and the breakup stage. I like to call this as everyone gets rudely punched in the face with the truth, and only the ones that know how to navigate it will be able to hold their nerve and make some money. This is the phase where the reality of overvaluation sets in. Market drops. People say, it's just a little dip. This is the financial equivalent of ignoring texts from your partner saying, we need to talk. What I'm trying to get at is in this phase, the stock market just comes tumbling down, triggering widespread panic and sell-offs. Accounts bleed red. This is when bad decisions are made at 3 a.m. and it's next to impossible to be unaffected. Even if you manage to predict all the signs of the crash in phase 1 and prepared correctly, phase 2 is really where you get tested. It's more about human psychology, as most people's initial reaction is to sell their investments and cut their losses. You need to seriously ask yourself, what are you going to do when the market goes down? Everyone says they're long-term investors until the market crashes. It's very easy to be a long-term investor while everything's going up. If you believe in your investments, then you have to hold firm. To have this kind of belief, you need to know why you invested in something. That's why it's so important to understand the fundamentals of a company before investing in their stock. This reminds me of a story Peter Lynch once shared. He's a well-known investor, and back in the day, he bought shares in Kaiser Industries when they dropped significantly. The company had zero debt, making bankruptcy very unlikely. He thought to himself, how much lower can it go? But the price kept dropping to under $10. He was shocked but held on, and the stock eventually rebounded to $50. The point is, if you don't understand the company, what will you do when the stock keeps dropping? Probably sell and lose out on potential gains. This applies to index fund investors as well. A study by Fidelity actually found out that if you invested $10,000 in a simple S&P 500 index fund between the 1st of January, 1980 and the 31st of December, 2022, you would have $1,082,009. But if you decided to sell your investments and ended up missing the 5 best trading days, then you would only have $671,051. The crazy thing is that missing out just 50 of the best trading days brings you all the way down to $76,104. So you might think you are being smart by time in the market, but in the long run, you're probably only going to hurt your own profits. But if you believe in your stocks for the long term, there is a lot more to it than just holding firm. In 2008, with what the dollar stores were doing, and instead of seeing a competitor, smart investors saw an opportunity. If things were bought for a bargain price, then it must mean there were amazing deals available. So smart investors went out hunting. They went on a bit of a buying spree over the next couple of years and acquired lots of different assets, including stocks and even entire businesses. They knew that they would be unable to time the exact bottom of the market, so they invested every week. This is called dollar cost averaging. Cash is really king. If you have cash, you can snap up some amazing investments during this time. Which brings us to the big question, how do I even get money to invest? Great question. Here's how smart investors prepare. Build a 6 to 12 month emergency fund, so fear doesn't control you. Cut unnecessary expenses before the recession. If you're paying $9.99 monthly subscriptions you forgot about, fix that now. Start a recession side hustle. Delivery jobs, online freelancing, selling unused things, small gigs. Recessions reward resourceful people. Also, automate saving and investing. Even $10 to $50 per week adds up fast. That's why it's super important to keep a steady income and supercharge it with a side hustle during times like these, as the more assets you can invest in, the better you'll probably end up doing in the next phase. The bottom line here is that while some choose to panic sell and lose all their money, others choose to double down and buy the dip, which if done correctly, can make you a fortune. I feel like I should also mention that some investors, such as Michael Burry, like to short stocks, which is basically betting that a stock will go down. It's quite a good strategy also. If you want to know more about this, let me know in the comments. Number 3, the glow up stage. In this final phase, the market begins to recover and rebuild, rising from the ashes of the crash. It usually pushes above and beyond the last market highs. If you noticed, 4 years after the 2008 crisis happened, just after the London Olympics, things started to improve. Businesses were hiring and money was a bit easier to come by, but even though people started to have cash again, the mentality of not spending carried through for a while. So it was another 4 years really until everything was back to normal. There have been a lot of crashes. I'm talking Black Monday, the dot-com bubble, the 2008 financial crisis, and the 2020 pandemic. One of the key lessons we can take from all of this is that a bull market almost always follows a bear market, and that the seeds of your fortune are often sown in times of crisis and uncertainty. As long as you are able to handle your level of risk and you're buying into the stock market consistently with a diversified portfolio, then you stand a much better chance than most at making some real money. Because investors who stayed calm thrive. So let's wrap things up. How do you actually prepare, invest, and profit before the next crash? Here's the real strategy wealthy people use. 1. Keep 10 to 30% cash ready. Not under the mattress, but in a high-yield account. 2. Build a watch list. Strong, profitable companies. Industries that survive recessions. Businesses with low debt. 3. Dollar cost average. Every week, buy a little consistently. This makes crashes become discounts. 4. Invest heavier. During the panic phase, not recklessly but strategically. This is what the wealthy do, and it works every single time. 5. Diversify like a pro. Be it stocks, index funds, real estate, maybe commodities. Make sure to diversify your investments. 6. Focus on assets, not noise. Don't let Twitter convince you you're poor. Stay focused. 7. Stay calm. People lose money not because of the market, but because of panic. Remember, the market recovers. Always. Listen, recessions aren't the end of the world. They're the beginning of new opportunities. Where most people see fear, a prepared investor sees opportunity. Every great fortune, from Rockefeller to Buffett, was built during economic chaos. They stayed calm. They planned ahead. They invested when others ran. That can also be you. So don't fear the next crash. Prepare for it, profit from it, and come out stronger than everyone who panicked. Before you go, smash like if you learned something new, and hit subscribe so you don't miss the next wealth building video. Your future self will look back and say, "Good call, leave smarter."